first, guys? Problem 612. Foxborough. What would you do first? Yeah, let's put the name of the company down, huh? So we're just going to directly do the statement here. You don't have to make any journal entries, nothing. By the way, when I'm writing down those journal entries and those T accounts, it's to figure out what the journal entry was, not the recorded one, right? They're already done. The balance sheet, income statement's done. Everything's done. I don't think this statement adds a whole lot, by the way. I could figure it out without somebody preparing it for me. Right? Here's the danger with this statement. Here's a little bit of additional information on it, but you could have figured out most of it from the balance sheet income statement. The danger is people who don't understand accrual basis accounting will go straight to the cash flow statement and see how much cash the company generated. I can make the company generate as much cash as I want. All I have to do is borrow a whole bunch of money, not pay my bills. What do you think? That's good business strategy, right? Borrow as much money as you possibly can and not pay your accounts payable and your accrued liabilities. Recipe for going broke. But it gives you less cash. Everybody with me on that? Okay, so, or you could sell product to people you think aren't going to pay you. Right? There's all kinds of things you can do here, right? Okay, so anyway, don't pay your bills. So anyway, this statement adds some, but not a lot, and it's useful to manage your cash. It certainly is, and it's pretty simple to put together. It's not really a big deal. You can do a little computer program to do this, where it does almost all of it. Okay, but I want you to know what a cash flow statement is, so you see it. When you guys are running your own company, or helping run somebody else's company, or running somebody else's company, I want you to use a whole set of financial statements, right? And it's okay to look at the cash flow statement too. I'd look at it last, after I was done with the balance sheet statement, equity statement, certainly, read all the footnotes. Right? Then look at it, sure, it's fine. Okay? There's a few additional pieces of information. So let's put the company name on here. Foxborough, huh? Okay, and we write out the name nicely, right? For me, I don't care on this quiz and test final. However, in real life, you want to spell the name properly before you hand it to your client. Might be a good idea. Yeah. Anyway, and this is going to be what kind of statement? Cash flow statement or statement of cash flows? It's fine. For a year ended or for a specific date? Year ended because we started at the beginning cash, go to the ending cash. Okay. Okay, what's this year ended? Just year 2, isn't that what it says? Okay, but it'd be what? December 31st, 2014 or something. Okay, anyway, so what are the 3 sections we're going to have in the statement? Operating. And then what do we go down about half the page and have? Investing. These are upside down like we said last time, right? Because first probably you get your financing, not probably, definitely. You get your financing, right? And then you invest, and then you run a business off it. Okay, so investing, and then what's the last piece? Financing. I think a really good place to start is with the answer. Okay, so let's go down here to the bottom. So more room this time. And let's put in increase or decrease in cash. What happened to cash? Let's look at cash there, and you can see this one went down too, didn't it? Maybe between year 1 and year 2. By the way, did cash go up? Very funny, right? Yeah. Okay, so whatever it is. Okay, so we can say decrease in cash. Sound good? How much was that? 8,000, whatever it is. Okay, I guess they're all in even thousands or millions or something, so just put 8, okay? All right, and that's less, so put brackets around it. So now what are we going to try and do? We're going to write down the change in every single account. Oh, by the way, put a check mark next to cash account. You did it, right? Down to that. Don't put it on again. You'd like to do that. Put it up on the current assets in the bottom too. That's twice. Don't do that. So anyway, what I want to do is I want operating plus investing plus financing to add to negative. And I know I'm done when it is. Right, guys? So be sure you get that number right before you start. Okay, where do you want to be? Okay, so here we go. All right. What account would you like to start with? You said you don't like the order I did them last time. Do you have to do them that order? You do any order you want. You can go alphabetical, right? Yes, not alphabetical. You could go in the order they're on the balance sheet. You could remember what goes where. I don't care. So, where would you like to start? We just did cash. You want to do accounts receivable second? I don't care. How do you like it? That's fine. Okay, yeah, it doesn't really make any difference. Okay, but you have to leave room under operating for what? Net income and items you might add back. What's an item that you always add back? Assuming we have any building and equipment at all, what expense do we add back? Depreciation and amortization expense. So depreciation, and it might have amortization too, right? And it's the expense we add back. And then we might have what else? Gains and losses. So let's leave a little room for some gains and losses. And we would add back which ones? The losses. That's subtract the gains. And these are gains and losses on investing and financing activity, right? On non-current assets, buying or selling non-current assets and refinancing long-term debt. I won't do that, but there are gains and losses on that. Okay? Remember we did that with the bonds, gain and loss, retirement bonds. Okay, anyway. So good. So you wanted to start with accounts receivable next. So where did the changes in the current assets and current liabilities go? Why do I have current assets and current liabilities? Accounts receivable, you get my sales. Prepaids, because I have to. Inventory, you get my sales. Accounts payable, finance my inventories. Accrued liabilities, you know, from running the business, my salary is payable, my rent payable, right guys? All that stuff relates to what? Operating the business. Operating, yeah, operations section, operating. Okay, so what I'm going to do then is changes in current assets are going to go here, and so are changes in current liabilities. And we said last time, that's supposed to be here. Okay, now, so change. If I have more of a current asset and I pretend everything relates to cash, right, for the statement. If I have more of a current asset, I must have bought it with cash. So I have less cash. If I have less of a current asset, I must have sold it for cash. The way you think about it, or you didn't replace it, so you have more cash. Everybody got the idea? Right? In the case of accounts receivable, I didn't collect it, so I have less cash. If it goes down, I did collect it, right? I have more. Okay. How about the current liabilities? Accounts payable goes up, what happens? You borrow more money. Accounts payable goes down, what happens? You pay cash out, you pay it down, right? And we pretend everything was with cash, okay? So just write down the changes. So what are the current assets besides cash? I've got accounts receivable. What else do I have? Inventory. What else do I have? Current equipment. Do I use equipment in a year? Prepaids. No. Prepaids. Equipment is a what? It's a non-current asset which is going to go under investing activities. Yeah, something I invest in. Okay, so we'll put prepaids here. Everybody got it? All right, very good. So what happened to accounts receivable? Up or down? Up by 70. So I failed to collect 70,000 of my sales, right? Do you agree with that from this year? So that net income that we have this year of 63,000 is short, right? Or is too much rather, by 70, right? Because I didn't collect some of the revenues. You got the idea? Those sales of 700, I didn't collect 700. I collected 70 less than 700. Okay? So we don't change the income statement because it's right. What we're going to do is we are going to say, well, I didn't collect. So this is a decrease in accounts receivable. So you can say decrease in accounts receivable. Okay? 70,000. And I have less cash because I failed to collect. Make sense, guys? Not a very big deal? Okay. Check that one out. Inventory, what happened to it? It also went up. What, 48,000? Is that what that is? So what do I pretend I bought it with? I said decrease in accounts receivable. You guys said you already know how to do this, and that's good. So we're just doing a review. Been working at it, you probably do. Did accounts receivable go up or down? Went up, I should have said. Increase in accounts receivable. Right? It means I had 70,000 less cash. Okay? 70. We'll just put it in 70. Okay. Inventory went up too, so therefore what happened with the inventory? We must have bought it with cash. Really, we probably bought it on accounts payable, but we're gonna do accounts payable under the current liabilities anyway, so we pretend everything ran through cash, okay? So inventory went up by 48, so I have less cash than if it had not gone up, is the idea, okay? Right? Prepays, what happened to the prepays? They went down, okay? So what happened is I have expenses on my income statement that didn't use any cash. What do you think about it, right? Debit expense, credit to prepays, right? So, right, I have more cash than if I had replaced them, is the way you can think about it too, right? Okay, so a decrease in the prepays does what? How much was it? No. Okay. That gives me actually, believe it or not, more cash than if I had replaced it. Making sense, guys? This falls right out. Okay, so then we're going to do the current liabilities, the next group down here, okay? Why not? Well, or we could just keep going, but you know what? The non-current assets are more work. You might run out of time. So my idea would be you go down and do the current liabilities. I don't care, right? Not really. Yeah, she asked me, I mean, does the order matter? No. Or anything you want. Okay, so what accounts do you have check marks next to now? That's it. They're done. I'm not going to touch them again. Everybody got it? Cash, accounts, receivable, inventory, prepays. I put a check mark next to each one and forget about it. Okay, I'm done. What are the current liabilities? Go ahead and do them while we're thinking about it. Probably not accumulated depreciation. Why is that down there under the credit balance accounts? Because it's a contract set. You got to know that for this one. Don't put that in the liabilities. Accounts payable, that a current liability? Yep. What happened to it? The increase in a current liability accounts payable. How much? 50,000? You don't pay your bills. What happens to your cash if you don't pay the bills? You got more. Right? And that's not a mistake, right? The inventory went up and we financed it with accounts payable is what probably really happened, right? Okay, we show them both on here. Okay? Now you can put a check mark next to accounts payable. What happened to accrued liabilities? It went down, didn't it? What did we pay it with? Cash? 8,000? Everybody good? Okay. By the way, if you realize you want net income, could you put it in there if you want? Anytime you want. But when you do, what do you want to do? Do the whole account. So it's probably also going to be the besides net income or net loss. Well, depreciation would, but that's on the income statement. That's when I analyze a different account. That's not retained earnings. Net income's analyzed retained earnings, isn't it? What else is in retained earnings with net income or net loss? There could be what? Dividends. Yeah, dividends go in retained earnings, right? So if you want to put in the net income, don't just write the net income down and keep going. Because then you'll probably end up writing down the net income, the change in retained earnings, and dividends too. And you'll double it up. Or you'll forget the dividends. Just put the net income. Make a mistake that way. Don't do it, right? Do the whole account when you're doing the account. Why did I object to you saying depreciation expense? What account are we analyzing when we do depreciation expense? It's included in one of the accounts. Which one is it? On the balance sheet. You guys know the journal entry. How do you record depreciation expense? You debit depreciation expense and credit what? Accumulated depreciation. Where do you think depreciation expense is on the balance sheet? In the accumulated depreciation. Please don't forget everything you learned in the first, what chapter are we on? Plus the appendix, right? So this is the 13th thing we've done, I guess. Don't forget the other ones, the other 12, right? The whole course when you do this statement. If you forget the whole course when you do this statement, you'll get the spot on. Because there's magic, how do I know, right? It's the change in the balance sheet accounts that you made when you made all the journal entries preparing those statements, right? Imagine how easy this is if you made all the journal entries. And now you're just analyzing what the journal entries were that you made. So if you know what these journal entries are, because you got it still at a basic level, believe it or not, guys, they're still pretty basic, right? So pretty simple, okay? But it's the same model that we use for complex businesses. It's what Young Brand's doing, right? Okay, same deal. They do a cash flow statement. Their cash flow statement is not very difficult either, because none of them are. Because they already did all the accounting, right? All the debits and credits to get their balance sheet, their income statement. Okay, so let's keep going. What account you want to do next? You want to go back up to loan to Harker, maybe? Oh, by the way, did you put a check mark next to accounts payable and accrued liabilities? Yeah, okay. So I guess we'll stay in sort of order. Loan to Harker, what happens to loan to Harker? Nothing to 40. Does it say anything down below about it? Doesn't, does it? Doesn't see anything about it. So, two things we could assume. We could assume that's a current liability, I guess, and put it up with their operating. More likely, what is it seeing as the loan to one company? It's that big relative to this company's balance sheet. It's probably a non-current investment of some kind, non-current notes receivable. So if we treat it as non-current, where would we put it? Under investing. What would be the journal entry for this, by the way? Debit loan to Harker, which is a note receivable from Harker, really, right? And credit what? Cash. So I bet cash went out. And where do you want to put it if it's non-current asset? Under investing, because all the current assets and the current liabilities go up under operating, right, guys? We said last time. And all the non-current assets, buying and selling them. Here we loan the money out to the bought this note, right? By giving them the money. Go where? Under investing. What's going to go under financing? The non-current liabilities and the equity. Other than dividends, which goes, or I'm sorry, other than net income, which goes where? Under operating. Dividends do go under financing, right? Okay. All right. So here we go. Let's put loan to Harker in here. So increase in loan to Harker, right? We loan to Harker. We just loan to Harker. How much? More or less cash. Yeah. By the way, you know what a real common mistake here is? I do it all the time. You fail to put brackets around something. Something that should have brackets around it doesn't have it. Something that should not have brackets around it does. How much will we be off? Let's say we failed to put the brackets around that 40 there. We'll be off 80. So when you get done and you add it up, you take how much you're off and divide by what? 2, and see if you can identify the number pretty easily, right? Did I screw any of them up yet, or did I all go in the right direction? Think so? Okay. All right. All right. Even though the form looks really awful, but okay. I want to get it all on one page so we can work it on the right-hand side of the cameras. Okay. You see it all in one place. So I apologize for how small that is. Luckily, you guys are done. Okay. Good nice stuff. Plant equipment would be next. Oh, check off loan to Harker. Right. We're done. By the way, could we loan them money and then pay us back too? Sure. And what would we show? We show cash going out when we loaned them the money, and we show cash coming in when they paid us back part of it. Right? Okay. So on the operating section up here, we're just going to show the change in the current assets and current liabilities. Why did I say that was last time? Why are we only showing the change? Because there's a whole bunch of transactions. How many times do you debit accounts receivable and credit accounts receivable? Every time you sell something, you debit accounts receivable, over and over and over. Every time your customer pays you, you credit it. How many times do you debit and credit inventory? Every time you buy something, you debit inventory. Every time you sell something, credit inventory, debit cost of goods sold. Right, guys? You know this stuff, right? So there's lots of transactions, and the ending balances aren't very big in those accounts, really, usually, right? Relative to the total balance sheet. So we just show the change. What do we do? Why under investing and financing we show both increases and decreases? Very few transactions, and they're huge. How many times do you buy a building, right? Compared to how many times you buy inventory. It's ridiculous, right? It's big, okay? So we put the purchases, and then how many times do you sell them? Almost never. Got the idea? So we show both the increases and decreases. So you really have to remember that. It makes sense, doesn't it? How many times do you issue bonds? Or mortgages, or something like that? Not very often a year, right? How many times do you pay them off? Not very often. Probably once issued, once paid off. Maybe a year. Maybe not even that. Okay? Maybe every few years. Okay, good. So let's keep going. We got plant and equipment. So that now it gets tough. What goes with plant and equipment? Yeah, accumulated depreciation. Okay, now I want to go a little bit slower this time. This stuff, okay? Rest of the other stuff. Let's do this kind of slow this time around. What do I know about plant and equipment and accumulated depreciation? Always write down what you know and solve what you don't know, right guys? For that over and over. What do I know about plant and equipment? Began at 500 and ended at 620. When do you increase plant equipment? This is the beginning. This is the ending. When do you increase plant equipment? When you buy equipment. What do you bet this is purchased equipment? You think so? Of course it is. What's the minimum amount we must have purchased, seeing as it started at 500 and now it's 620? 120. Could I have bought more than that? Yes, if you did what? Sold some or retired it. Retired means we use it completely, fully depreciated, and then we just throw it away or give it away or something. Okay, retired. So sold or retired. Okay? All right, we still have to take it out with it. So by the way, what would that do if I retired some of the plant equipment? What would you do? Credit it. So here's sold plant equipment, sold or retired over on that side, huh? Okay, what do I know about accumulated depreciation? They're just beginning. 65 million. When do you increase accumulated depreciation? When you debit what and credit what? Obviously, credit bigger. Accumulated depreciation, debit what? Depreciation expense. Sure, that's the depreciation expense. That's the depreciation for the period, isn't it? Yeah. But what's the minimum depreciation expense must have been for this company then? 35, that's how much it went up by. Could it be more than that? Sure, if you did what? Sold some. So the sold comes out both sides, guys, right? If you retire an asset, sell an asset, don't you have to get rid of the asset in plant and equipment? Sure. You know, if it's building your equipment, you have to get rid of it, don't you? Okay? What if there's accumulated depreciation on it? What would you want to do? Get rid of it. Let's say I have a $100,000 asset. It's got $30,000 accumulated depreciation. Net book value is 70. What if you just get rid of the asset, the 100,000 asset? Well, you have a negative asset left of 30, right? Nobody's going to do that. You're going to get rid of it. You already know how to make those entries, don't you? Okay? So those are the possible entries. Tell me what the journal entry would be if I buy some. I'm assuming everything runs through cash at this point. Later, we won't do that, by the way. Okay? And they show you an example of that. Non-cash transactions go to the bottom of the statement. I'm not going to give you any of those. Okay? If I buy a building and issue a mortgage for it, and there's no cash change hands, I might just put that at the bottom of the statement. Okay? If I give somebody stock and settlement of debt, I might just put that at the bottom of the statement. I won't do that to you guys. We're going to pretend it's cash at this point. Okay, so what would be the journal entry to record a purchase of plant and equipment? Debit what? Plant and equipment. You already know this, so you're going to just look for this information. And credit what? Cash. We pretend everything's cash. Absolutely. Okay. What if I sold something? Debit what? Cash for whatever I got. Okay. What else would what would I credit? Plant and equipment. What do I want to get rid of on it though? Accumulated depreciation. And that journal entry probably won't balance, right? The cash will either be more or less than the book value. If it's more than the book value, what do I have? Gain. I'd have a credit to gain, right? So I'd have to take care of that. What if the book value is more than I got for it? Book value is more than the cash I got. Loss, right? I'd have to debit a loss, right, guys? So that's it. What about the depreciation over here? How did that depreciation get recorded? Credit accumulated depreciation, right? What do you debit? Depreciation expense. Is there anybody in the room that doesn't know how to do all three of those journal entries already? Of course not. You all know how to do it. Just use what you know, right? Trying to get you guys to use what you know. You won't be particularly valuable remembering things. Never get you to do that. Right? Of course, there are going to be lots of things you remember because you use them all the time, right? Things you don't use all the time, you'll quit remembering, but guess what? You can always look it up and now you know it. After you really understand it. And, oh, that's what's up. I figure. Got it? Okay, so you're trying to develop a knowledge base here and the ability to use it at the same time. Okay? Whole idea of your education, really. All right, anyway, so what do we know? Somebody tell me something we know to fill in some of these numbers. What they give us. We wrote down everything we knew about the balances. What do we know about the equipment? Down at the bottom, what do they say?
Costs 30.
Costs 30, so where does the 30 go? It's a credit. Sure, I'd take the 30 out of here, wouldn't I? That's going to be this entry here, isn't it? Absolutely. Okay, we did this a long time ago now. And what else do we know about that?
You sold it for 26.
Okay, so that's a debit to cash for 26, I bet. What else do we know? And where is that going to go? Yeah, we're going to take it out of accumulated depreciation. Okay. Everybody got it? They need that one 20 else. So it was like the last problem, but whatever it is. Okay. Huh. What was the book value of this thing? 30 less 10, right? Everybody agree? It's 20, and we sold it for 26. What happened to me if I sold something in some of my books at 20, and I got 26 cash for it?
6,000 gain.
6,000 gain. You got it made now. Okay, what do I want to do? I want to show this 20,000 change, right? This one plus this one plus this one, right? I want to show that net. I want to show that 20,000 change to the account. Okay? Where am I going to put it? Where am I going to put the sale of a non-current asset? Investing, because investing is the non-current assets, buying and selling. Okay, so what I did was I sold, what was it, equipment? Sold equipment. How much cash did I get? Just the cash, guys. How much? 26. Now I said, so am I going to add or subtract cash if I debited cash? Going to add, of course, right? Debit to cash. Okay, you know it's a debit, right? See that? You know it's a debit. Okay, so 26 isn't 20. What do I want to do? I got to do something with that gain. Now listen to this carefully. The gain is included in the 26 cash I received. Would everybody agree with that? And the gain is also included in the net income I'm going to put up here later. Look at the income statement. See the gain on the sale of equipment there? I counted it twice. What do I need to do? Subtract it. So what I'm going to do is I am going to deduct the gain in here, aren't I? So let's deduct the gain on the sale of the equipment. Got it? So that was 6, was it? What is 26 positive less 6 negative? 26 minus 6. What is it? Right here, 26 and 6. The difference is 20. And I have explained this 20 change. Do you see it? Get your head around that or this is going to drive you crazy. Okay? It seems like magic. Why do I add back gains? It seems backwards, doesn't it? Shouldn't the gain be added? Well, it was. And we don't want it there. We want it down under what? Investing. I want that 6 gain under investing. Not that I want the gain there. I want the 26 cash I got there, right? I want it under investing. Okay? So if you leave the 6 in net income up there and you put 20 under sold equipment, what am I going to do? Mark 2 off. 1 in each place, huh? Okay, so don't do that, right? It doesn't make any sense. Okay, now what do I know? Actually, I know what depreciation is, and I know what the purchase of equipment was. Did they give me either one of those in this statement, or in this problem? They didn't give me either one, did they? Oh man, that's really mean, isn't it? No, it's not. How much was the purchase of assets? I started with 5, what was it, 500? Can't read it right. Started with 500, I took 30 out. What does that make it? 470. Now it's 620. How much did you add? 150. Even I can do this. I'm really, really old. Okay? So we got 150. You know I have no memory. Figuring it out, right? That's it. Now we're doing the cash, not the plant and equipment, right? I'm explaining that 150 change here, but what happened to cash? Went down. Where do I put it? Buying and selling non-current assets go under investing. So see here we got 26 came in from selling plant and equipment. This is going to be purchased, and I don't know if it's plant or equipment. Plant being the building, probably land too, by the way. The plant and equipment, right, would go in here. In real life, we'd have, of course, a land account, a building account, an equipment account at least, right? But you still handle it like this. So what's that going to do? 150? That's how much cash went out. Everybody agree? And put brackets around it because cash went out. And now what can you do? You can check off plant and equipment. What do we have left here? depreciation. Okay, it started at 130. I took 10 out when I retired that asset, right? So what do we got? 120 left, and somehow miraculously it got up to 165. What do we put in? 45. That's the credit to accumulated depreciation. Of course, what's the debit? Depreciation expense. And how much cash went out for that expense? None. Right, guys? And when you look over all the operating expenses included in that operating expense, believe it or not, maybe some of it's in cost of goods sold too, by the way, if I manufacture. Where is that 45,000? It's included in operating expenses. So my net income of 63 is short 45,000 from a cash standpoint. I've got to add it back. That's why I'm adding it. It didn't use any cash. It's not that depreciation supplies any cash, it's that it doesn't use any. And you've taken it out of net income, so of course you got to add it back. Does everybody see that one? Is that making sense? My net income's too low. That's all it is. Are we good? Okay. Did I screw something up? Just passing notes electronically. Yeah. You just have to use paper. Of course, you could have just called her, right? Better not. I was actually in the bar once where you see this on TV and stuff. People do this. These guys are on the opposite end of the bar, talking to each other. Two guys talking to each other on the other end of the back. They're friends, and they're just sitting in different places, I guess. And the bartender realized they weren't and kicked them both out. I thought it was really funny. So, you know, this is bad enough. It's a noisy place. Your friend will have to sit next to each other, you know, talking on the phone opposite end of the bar. So, don't ever do that. They'll kick you out. Pretty fun. We're kind of addicted to our phones now. It used to be rude to go sit and have dinner with somebody and you're on your phone and they're on their phone. Now my wife and I do that all the time. But people thought we're old, luckily, so they probably don't think we're dating, right? But there was this, we went over to Lexington this weekend and we're in this nice little restaurant with open air and all this stuff. So by the opera house. Anyway, so we're in this little place. And somebody's sitting outside at a table, and my wife and I are inside. And this woman is talking on the phone the whole time. And this guy is sitting there, you know, looking very frustrated. And then he's going, how do you make your little phone sign? He's going like this and hang it up over and over, and that's hilarious. So, yeah. They didn't use a phone, that's good. It's just a calculator. Okay. Anyway. So, what do we do next, guys? What are we done with? Plant and equipment, accumulated depreciation, right? What's the next one? We're done with all the assets, aren't we? Where were we at? Bonds payable. Okay, let's do bonds payable. What happened to bonds payable? Went up by 90. Now, they don't say anything about the bonds payable, so what must they have done? I guess they just issued 90, right? Credit bonds payable and debit what? Cash, sure. You can write down the entry if you want. We don't really need to in that one, do we? So what do we have? Issue bonds payable. Now, could it be, if they gave us this information, oh, by the way, it's credit cash, right? So I have less cash by 90, is it? Okay, good. Could it have been, they started with 100. Could they have retired the whole 100 and then issue 190 new ones? Yes, or they could retire any portion and issue one, right? So if they had done that, what would you do? I'd show cash going out of 190, right, guys? Did it go up by 90 or down by 90?
Up by 90.
Oh, geez, what do you think the journal entry is? Anybody notice I did that wrong? It's credit bonds payable, isn't it? And debit what? Cash, excellent. Yeah, we have more cash. Come on, Keith. They had it been off by 180,000. Could they have retired the 100 though, and show a reduction of cash, debit bonds payable, credit cash, show 100 reduction of cash, and then issue the 190, debit cash, credit bonds payable? Sure. And what would you have done if that was the case? Show two lines, one for issuing debt, cash going out, one for retiring, issuing debt, cash coming in, another for retiring the debt, cash going out. Everybody got it? Just like on the plant equipment, we bought some and we sold some. You could issue debt and then retire debt both in the same year. Everybody good with that? Okay. Well, now you can check off that one. How about deferred income taxes? It went up by 4. What's really going on with that? What's their income taxes on their income statement? 27,000. What would be the journal entry for recording that 27,000 income taxes? If they know. Okay, we're going to have a debit to income tax what? And a credit to income tax what? Yeah, I just see income tax payable, that's the credit, isn't it? Okay, so you're going to credit income tax payable and you're going to debit income tax expense. And then there might be something to deferred income taxes too. Because I'm going to put up paying it till later. Remember the deferred income tax we did really quickly? The author did it pretty quickly too. What's the tax expense? It's 27, it's on the income statement. Do they show any income tax payable? No, what must they have done? They must have actually paid it out. They might have credited income tax payable and then paid it later with a debit income tax payable and credit to cash, right? They didn't went out to cash. Did I pay the whole 27? No. What happened to deferred income tax payable? It went up by 4. How much do you think you paid? You know, your expense is 27 and you didn't pay 4 of it. How much do you think you paid? 23. Oh, that's the cash that went out, okay? So what am I showing on my income statement for taxes? 27, everybody agree? You see it? Tax expense. How much did I pay? 23. I put 4 in deferred income tax. So what does the author suggest we do? Add back, I still can't leave myself enough room, I'm driving myself crazy here. Add back what? The increase in deferred income tax. What if the deferred income tax went down? I must have paid more cash out. It would have been a debit over here to deferred income tax payable, right? Would have been a debit here to deferred income tax payable, and the cash going out would have been more than the income tax expense. If those timing differences are reversing, right guys? Okay, all right? So I'm going to add the deferred income, the increase in deferred income tax payable, and how much was that? 4, okay? So we put that in there after net income, okay? Actually, probably after the depreciation expense. Okay? So, and I won't worry too much in order with you guys. Just get in the right place. By the way, do you need to leave yourself more room than I'm leaving myself here? Yeah, use a whole piece of paper. Unfortunately, I got a little tiny screen here. Okay, I'm trying to keep it on one page. All right, so now what do we do? Oh, by the way, what can you do now? Check off deferred income tax, right? What happened to common stock? Went up by 60,000. What's that going to be? Credit common stock and debit what? Cash, because I issued common stock. Where does it go? What are my 2 sources of financing? Long-term debt and equity. Issue common stock. Now, big deal. How much is that? 60,000. You guys good? Are we happy? By the way, could I have retired some and issued some? Bought back treasury stock and issued some? Yeah. What would I do? Show balls. Everybody got it? If I retired some, cash out. If I issue some, cash in. And you can tell by the debit or credit. It's credit common stock, guess what? It's a debit cash. Everybody got it? What do I have left? Which you might have started with this account, but we'll do it last. Why not? What account do we have left? Retained earnings. And this is just not a big deal. What do you know about retained earnings? I'm analyzing. Oh, by the way, check out common stock now, right? We've checked out everything but retained earnings now, haven't we? Sort of doing them in order, I guess. Let's write down what we know about retained earnings. What was the beginning? Right. What was the ending? When do you increase retained earnings? When you record net income. That's when you close the revenue expense accounts and add net income to it, right? Or if you're doing a monthly or a quarterly statement, you don't actually close, but you still add the net income to it, don't you, to make your balance sheet balance, right? Remember all that, you guys, doing the statements? Okay? When do you reduce it? When you have a net loss? Could have a net loss. By the way, if this was a net loss, what does that do to cash? If less cash, you lose money, right? Like brackets. okay? If everything ran through cash. And we have net income here. So what was the net income anyway?
63.
No, wait a minute. 90 plus 63 is 153 and it's 20. What must have happened? Must have paid a dividend. For some reason they gave you the dividend. They didn't have to, right? Okay, what was the dividend? Yeah, but they told you 33, but we know it's 33 anyway, don't we? Because 90 plus 63 is 153. Some number away from 153 is 120. It is 33, right? Okay, so the net income is all the revenues and expenses. Where do we want to put that, seeing as, you know, that's what we get from operating our company, the net income? Where do we want to put the net income? Under operating. It's the first item you can put under operating. Everybody good? Okay. Where do you want to put the dividend? Financing, because it's a repayment to owners of some of their investment, basically, right? Okay? Really, it is. Okay? So, dividends. They can just be declared. They don't even have to be paid. These were paid, I think. Okay, 33. Do I have more or less cash? No, if I debit retained earnings, what am I crediting? Cash. I have less cash. Everybody got it? Now you can check off that one. Now what will you do? Yours is going to look so much prettier than mine does, I know. What are we going to do? Total, please. 100. So total those up. What do you get? Let's go ahead and actually do it. Put a dollar sign here, probably make it look pretty. Dollar sign there, dollar sign there, like that. Okay. What do we need over here? What about over here? Still doing it. Stop it. Put a dollar sign here, right? Okay. So what's 63 plus 4 plus 45 less 6 less 70 less 48 plus 9 plus 50 less 8? What did you get? Are you looking at the answer? Did you actually do it? Good. Is that what's on the answer? Yeah, good. All right. You're not going to have the answer in real life, though. Good for you. Okay, good. What's the other one going to be? The investing. 190 less 26, how much is that? 1. Is that positive or negative? By the way, was this 39 positive?
Yes.
Yeah, okay, good. Is this 164 positive or negative? Negative. Cash going out for investing activities. So you can see where the cash came from, right, guys? From operations. It wasn't 63, it's 39. That's kind of unusual. Why did that happen? Because they increased inventory so much, they increased receivables so much, huh, guys? Right? Okay. And that's offset by the change to accrued liabilities and depreciation, but not enough, huh? Okay, it's kind of unusual. Usually you have more cash flow than real cash flow than cash flow from operations, or than net income, I'm sorry. Cash flow from operations is usually more than net income, not less. That's what it is with this company. How about financing? What happened to us? That positive 117. So what we did was we borrowed a bunch of money and we invested in assets, right guys? And then we took what we got from operations and invested in those assets too. That's what happened. Okay, so what's 39 less 164 plus 117? What do you get, we hope? Negative 8. Did it work? And when you're done, it's kind of like, oh, wow, I nailed this one. Right? So rework this problem, work the other problem, right? Again, right? Make it look nice. The order that they put it in is pretty standard on the solution. Right? Start with net income and then usually depreciation is next. But anyway, pretty much standard. So just make sure you have the operating stuff under operations. Make sure you have the investing under investing, and make sure you have financing under financing. And then be sure and put the total cash down at the bottom, right? Okay. Everybody good? Very happy? We're doing good. Okay. So, you want to do an example of investing in other companies? Monster, okay. All right. And what I'll, on the quiz, I'll probably give you pieces of this. But between the quiz test and final, I'll give you all of them, I promise. Okay? To be able to do it all. Okay? So let's say we have Lucy Company. Okay. Lucy Company, there are 200,000 shares issued and outstanding, okay? That's it. Let's say that the market value at the date of purchase is $6. The market value at the end of the year let's make that be $5, please. Okay. Net loss for the year. $100,000. But we still went ahead and paid a dividend. I don't know why they did that either when the market value is going down, but they did. And their dividend is $10,000. And then Lucy Company, let's give it a par of $1. Lucy Company in their equity has common stock, additional paid-in capital, common stock, and retained earnings. Okay? Now, can you tell me how much common stock would be for this company? That'd be your first question. What is it? 200,000. How'd you get that? Yeah, 200,000 shares have been issued, right? And it's $1 par. So no matter what they paid for them, you debit cash for what they paid, or debit land, building equipment, whatever the owner contributed, right? And you would credit common stock for $1, and then you credit additional paid-in capital for the rest, right? Very good. So what I've got here is 200,000. Everybody agree? And then let's say the additional paid-in capital is only $100,000. So what did the stock originally sell for, you think? I made that $1,000,000. What did the stock originally sell for? $1.50 a share. You got it, right? It's 200,000 shares, and you got 300,000 total paid-in capital. Everybody agree? We did a problem like that, didn't we, in a quiz? All this stuff is the same stuff, right? Let it be. When you're taking the final, relax. You're not remembering a chapter at a time, okay? The whole knowledge stuff. Okay, and then let's say retained earnings. Let's see what's this thing selling for. Let's say retained earnings at the end of the year, after paying this dividend and having a loss and everything, the retained earnings is still $400,000. Everybody good? So what's my total equity in the company? $800,000. Everybody agree? Okay. All right. So. Oh, it's 700,000. Oh, I can't do that. Okay, 700,000. Okay, 700,000. All right. So let's do different scenarios. Number one. Martin Company buys 10,000 shares. Okay. Number two, Martin Company buys 70,000 shares. Oh, wait a minute. Wait a minute. I better read some room here. We need 3 different scenarios on this one, don't we? A is they intend to hold for 10 days. B is they intend to hold for 6 months. C is they intend to hold for 5 years. Okay. All right. Do all those. Then 2. What we'll do on 2 is we'll mark buys 35%. Whoops, 35. That's it. More. Let's have market company. Let's have market company buy 70,000 shares. Okay, but it's the same share price, right? They're different scenarios. Okay, and then in number 3, let's have market company buys 180,000 shares. Okay?
What's the date they're buying?
Just at the beginning, the first day of the year is fine. So this is January 1st of that year. This is December 31st. Keep it simple. That makes sense? Okay, so we buy it January 1st, and we're still holding it at December 31st is the point. That's the year end back year end, December 31st. Do those.
What does it say?
Second one says they buy 70,000 shares. Martin buys 70,000. Third one says Martin buys 180,000. So what I got is Martin buys 10,000 shares, right? Because there's 3 different ways you could do it. One is hold for 10 days, one is hold for 6 months, and one is hold for 5 years. So give me the journal entries, all of them that are necessary for the entire year for all 3 of those. Okay? Then here, give me all the journal entries that are necessary for this one. Right? And then here, give me the journal entries that are necessary for that. Oh, and I should have one more thing, maybe. Let's do one more thing. Let's say they have building that is book value equals and market value equals. So we have something else to change, I guess. Let's say the book value is 100,000, okay? And the market value is 120,000. 20,000 more. Book value 100,000, market value 120. Where are you going to use that, by the way? Where are you going to use all this equity stuff down here? And the increase in market value. Where are you going to use it? Trading securities, whoops, gave away part of it. On these? No. How much control do you have here? None. On these? How much control do you have there? Significant influence. But no, not getting that's equity. How much control do I have here? All the control. When we vote, I win, right? I got 90%. Okay? So where am I going to use those values? Where I have control. So that's where I'm going to eliminate, right? So go ahead and do it. I wouldn't put all this in one column, obviously, of course. Or put it separate. Otherwise, things could go wrong on the math. This would be a lot of points. A lot of points. The rest of the class. Cash statement. 60 to 70 more points. Goodness. Really? There's a lot goes into it. There's only 40 points per chapter. Right? Do whichever ones you can do. Identify. First, what's the first one for all? I suck. January 1st. Maybe do that for all. Sorry. So then you know what you call them. Then what do? How much income do they have? How much dividend did they pay? Right? And what's the ending market value? And when do you record it and when don't you? Yeah. Then when you get down to part 3, it's all different. Right? First, part 1, A, B, and C, and part 2 all kind of relate to each other, kind of. This would be a nice exercise. Take a while to do that. Just make progress, you guys. Make progress. First, record all these guys. Go ahead and get that back. All the way. You guys are responsible for reminding me to turn this back on when we start again, okay? Good thing you said that. I guess. Somebody might want to listen to it. You might want him to do it when you get ready for lunch. Okay, so here we go. If I'm only holding it for 10 days, how do I record the investment, guys? Debit investment in trading securities. Okay? How much? 10,000 shares at how much? 60 grand, isn't it? Okay? Credit what? Cash. Whoops. Credit. Credit cash, 60,000. All right. What would I do then at the end of the year with this one?
You get a dividend, net income would have no entry, and the market value would be gone.
Okay, she wants to net income have no entry. I'd agree with that. So you write it down for me, okay? And I'd probably, well, you've seen it on the practice quiz, or you haven't yet, maybe? Sure, do the practice quiz. Got some of these on it, of course, right? Yeah, so if I give you a section that says, what do you do with the net income, what are you going to say? No entry. Okay, good. All right. What do you want to do with the, let's do the change in market value. So what happened? The market value went down? So we put the decrease in market value. What happened to my investment in trading securities? It went down. So credit it. You got it. Unrealized loss on trading securities. You like that? And credit the trading securities, right? Investment in trading securities. And if you want, you could use an allowance to reduce the market value instead and leave the trading security alone. Does that make sense? So I have an allowance to reduce trading securities to market value if you want the author to do it that way, which is common too. Both ways are fine. How much did it go down by? $1 a share on 10,000 shares is $10,000. So now, oh, by the way, what kind of an account is this unrealized loss of trading securities? Balance sheet or income statement? Equity or income statement? Income statement, right guys? I am going to reduce my net income by that amount, okay, for that loss. Do you agree that we paid $60,000 for these shares and now they're worth $50,000, so we have a loss of 10? Yeah. And the investment should go down by 10, right? Everybody agree with that? Okay. So then what would you do? What's the last piece that's left, you guys? Yeah, we got the dividends. So let's do the dividends. How would you record the dividends? What happened to me? How much of this company do I own? 5%. 10,000 out of 200,000. What they pay in dividends? $10,000. What's 5% of that? 500 bucks. So what did I get? 500 cash. Debit cash, 500. Right, guys? And credit what? Dividend revenue. The two sources of income on trading securities is what? The gain or loss on the change in the price of it, right? And what else? Stealing my book. Can you believe that? Okay. And what? Dividend revenue, right? So on this company, we lost $10,000 in value, but we made a $500 dividend, so we have a net loss on this company, $9,500. Get the idea? That's it. If you had a market value increase, of course, it'd be an unrealized gain. What do we mean by unrealized? You didn't get the cash, so you didn't sell it. By the way, what if I did sell it? Well, then I'd have a gain or loss on the sale I'd have to record, right, guys? Okay, no big deal. All right, so let's hold it for 6 months instead. What's that going to look like? Yeah, available for sale, investment in available for sale, let's call it that, right? Investment in available for sale, short term, how much is that? That's key. Short term, how much is that? It's also 60,000 because that's how much cash we gave them for 10,000 shares. And credit what? Cash. Ah. All right, guys, what do you want to do with the net income? No entry, because I don't, why? I have no control. I'm not making the net income happen, right? So no entry. The whole idea up here, I guess we should have said that, is I have no control when I only own 5% of the stock. At what point would I have control? Anything over what? 20% is your rule of thumb, right? Okay. That's a judgment call, because if somebody else owns 80 and you own 20, you have no control, right? You own 30 because somebody else has 7, you have no control. So we still use this method, okay? This is called the market value method, by the way, right, guys? Right, excellent. All right. So then, let's try the other approach then, or the other ones. Let's see, what are we going to do with the decrease in market value? What do we have? Unrealized loss. But where does this loss go? Because we're going to hold this thing for a while. On available for sale short term. It's going to still be 10,000, isn't it? $1 a share on 10,000 shares. Good. Where does that go? Which financial statement? Straight to the equity statement, straight to the balance sheet. Therefore, this is other comprehensive income, isn't it? Going to be equity. Okay? You can know that. All right? So it does not hit the income statement. What's the credit going to go to? What did we lose? What do we lose value on? Investment in held to maturity. Whoops, investment in available for sale. Where did I get that? Available for sale, short term. Everybody agree? All right? Okay. And then we have the dividend. How much dividend do we still get, of course? How much dividend? 500 cash. Same as this one over here, right? Same as this one we had up here. Debit cash 500. Credit dividend revenue. We're done. Exactly the same entry as we did when we call it the trading security, right? Now this is going to be crazy. When we do held for more, do it over here. What's it going to be? Debit what? Investment in what, you guys? Available for sale, and don't call it short term because it's long term, more than a year. So if they just give you one or the other of them, look at how long it was. What if it's only a few weeks or less? Trading security. What if it's between a few weeks and a year? Available for sale short term. What if it's more than a year? Available for sale long term. Up to forever, right? Up to forever. because you don't have any control, right? That's it. It's less than 20%. So long term, how much? 60 grand? And credit cash flow? Everybody agree? That's when I bought it. That's the investment in it, right? Okay? What am I going to do with the change in market value? Debit what? Exactly the same thing. Unrealized loss, but this time the unrealized loss is on what? An investment in available for sale long term. So what is it? Is all it is. It's $10,000 debit. That's a debit. And then the credit is to what? Investment in available for sale long term. Once you've got this down, it's just kind of a joke, guys. Okay? It's not a big deal. What's the difference between if I'm going to hold it for less than a year, but for more than a few weeks, and if I'm going to hold it for 5 years or for longer than a year, basically? What is it? Put long term in there. Put long term in there. Or put short term over here, long term over here, right? Okay, everybody got the idea? There it is. Short term and long term. Same thing here, right? Long term, short term, big deal. What are you going to do with the dividend? Debit cash, of course. How much did you get? Still 500. You can only own 5% of the company. Credit what? Dividend revenue. Exactly the same. That entry for the dividend is the same on all three of these, isn't it? Well, yeah, you got cash and you earned dividend revenue. Okay? Easy, huh? All right. So now, let's get it a little more difficult for ourselves. Make life difficult. What are you going to do if I'm buying 70,000 shares? How much do I own, you guys? 35%. What would you call that? Investment in affiliate, because I have significant influence. Debit? Investment in affiliate. Right? And you can put the company name on there if you want. You can always put the company name on there. Okay? What was this company called? Do you remember? Lucy. Yeah, Lucy Company. Got the idea? How much would I invest? 70,000 shares at $6. What's that? $420,000. What did I give them? Cash. $420,000. Okay. So I have the decrease in market value next at the end of the year, right? The decrease in market value. What am I going to do? Seeing as I have significant influence, I'm not just taking what the market gives me, like I would if it's a trading security or available for sale, where I have no control. What would we call this? What would we say for this one? No entry. Yeah, I didn't buy this for stock appreciation or depreciation, right? Okay. Obviously never want to take it or go down, but it could. All right, so then what else happens? They report the net income. Oh, let's do the dividends. I heard dividend. Let's do the dividend. That's okay. How much dividend do I get? Debit cash. And we own 35%. There's 10,000 total. What's 35% of 10,000? Yes. And credit what? Is it dividend income? No. I'm paying myself back part of my what? Investment. Yeah. So it's going to be investment in affiliate. So I put 420 in and I'm taking 3,500 back out. Investment in affiliate. So when I pay myself a dividend, guess what? I reduce my investment. That's it. Okay, Lucy Company, I guess. Okay, for $3,500. Okay, but there's also the net income or net loss. In this case, I made it a net loss. So this is awful, isn't it? What does that do to my investment? You lose money. What is your investment? You're controlling it. It goes down. So I am going to reduce my investment in the affiliate. That's what you guys did, I hope. How much am I going to reduce it by? How much was their income? 100,000 loss, was it? How much of the company do I own? 35%. What's 35% of 100,000? 35,000. So I reduced my investment by the dividend I paid myself, and I lost money. This is a mess this year, isn't it? Okay? And debit what? Loss on affiliated losing company. I think the author calls it something like equity interest in loss of affiliate, and something like that. That's perfectly good. There's lots of different terms we use for this. So loss on affiliate is good enough. 35,000. What if I asked you now on this one, what is your book value for the investment in the affiliate? Could you do it for me? What's the book value on the investment in the affiliate? How about 420 less 3,500 less 35,000? Could you do that? When you debited the account and you credited it twice. Pretty easy, isn't it? Everybody good? So that's where I'm at right now, whatever that is. Okay, now, what do we do if we own 180,000 shares? What's the deal if I own 180,000 shares, you guys? What percent of the company is that out of 200,000? 90%. Everybody agree? Yeah. Remember, there were 200,000 shares, right? I tried to get it all on one page. Impossible. Okay, so here we go. There's 200,000 shares. Everybody see that right there? Okay. And here's what I have in the equity account, right? This is $1 par, right? In all the equity accounts. So now I have control, and what do I want to do? Let's do the elimination entry. Well, first let's do the investment, and then we'll do the elimination entry, right? That's all we're going to have. Okay? So let's do the investment first. When I do the investment, what am I going to give them? Cash. And what are we going to call it? Investment in what, guys? Subsidiary. Excellent. And you can put subsidiary dash Lucy Company if you want, okay? So how much am I giving them? How many shares did I buy? 180,000. $6 a share? What's $6 times 180,000?
1,080,000.
Okay, 1,080,000. Excellent. 1,080,000. And I'm done. That's what's in my investment account. Okay? Now I want to eliminate this. So on the very first day after doing this, by the way, the dividends wouldn't even be paid yet. If I do give myself a dividend here and I want to record it, what would I do? Debit cash and credit dividend revenue. But then what would you have to do with the dividend revenue at the end of the year? Eliminate it. And eliminate the dividends from the subsidiary, because the subsidiary doesn't exist, so they can't pay dividends. Paid myself a dividend, right? It's weird, but that's what it is. Okay, let's do the elimination entry though. What do I want to eliminate, you guys? What did I buy? Let's figure out what we bought. What did I buy? I bought 180,000 out of 200,000 shares, 90% of what? Their assets, their liabilities, and therefore their equity. What's their total equity up here? We had common stock, $1 a share on 200,000 shares is 200,000. We have additional paid-in capital of 100. Stock sold for $1.50 a share, we said, right? And we've got 400 retained earnings. So what's the total equity? In other words, the assets less the liabilities. What is it? 700,000. Everybody agree? And what did I say? We had land. Whoops. What did I say? Building, maybe? Building has a book value of 100,000, right? Market value of 120. So 20 of what we paid was to buy that additional market value. Everybody agree with that? So let's write down what we bought here. Okay? The equity of the sub is how much? What did it total? 700, right guys? Everybody good? The minority interest owns what portion of that? 10%. So 10% of it's going to be the minority interest. You guys agree with that one? That's going to be 70,000. Everybody see it? That's my minority interest I'm going to use in a few minutes. Okay? Yeah. Simple, huh? Whatever portion we don't own is the minority interest. What if I own 51%? Well, then the minority interest is 49% of the total equity. Everybody got it? No big deal. Okay? You can calculate this. All right? What did I pay for this, or what did I buy? 90%, right? I 90% of that. So take this times 90%. What do I own? Well, obviously, if it's 700 total and the minority shareholders own 70, what do I own? 630. Everybody agree? I bought 630,000 of the equity, right? That's what the parent bought. Okay? What did they pay for it? What's the cost? What did they pay? Wow. There must be a whole lot of what in this company? Goodwill. Excellent. That's exactly right. We think this company is worth an awful lot more than its book value. Even though they now have lost some money, they only have 700,000 total equity, right? Which means their assets less their liabilities are 70,000. It's a fairly young company, maybe, huh? They've done well, and then this year it turned out horrible. But what do we think? We think this has a lot of future cash flows. We must have when we bought it. We must have thought that was true. So what's the excess we paid? We can do it just like this. This is kind of handy. So I have the total equity, what portion of it I bought, what I bought, right? My share, you could say. My share. Okay, the company's share, parent's share. Okay? There's the parent's cost. So what's the excess they paid? How much is that? Not 50. 450.
Yeah, 450.
Oh, did you say 450? I thought you said 50. Whoa. 450,000, yeah, right? 1080, 1,080,000 less 630. Everybody agree? But there's one other piece I gave you. I gave you that land increased in market value by 20, right? So increase in the market value of the land is 20. So what's the rest got to be? What's the 430,000, gang? Goodwill. Okay, we got it. Now we can do our journal entry. 430. Okay, $430,000. Let's do our journal entry. Okay. Now remember what the equity consisted of, right? What did the equity consist of? Common stock, 200. Additional paid in capital, common stock, 100. And retained earnings of 400. If you are going to get rid of this company, what do you do? Off your books, right? You're combining the companies, remember? 2 columns for the parent, 2 columns for each of the subsidiaries. You're adding them all across. You're adding up their assets. You're adding up their liabilities. You're adding up their equities. Eliminating the subsidiary's equity, right? We're going to record the minority share, which is still equity, right? Okay? And then we're going to revalue any assets. So what equity accounts do you want to get rid of? All the equity of the subsidiaries, right? What else do you want to get rid of? What represents that ownership? The investment on the parent's books. Whose books does this elimination entry go on? No one's. It's only on the worksheet, right? Because we're taking an account from the parent's books, the investment, and getting rid of it, and we're taking all the equity accounts from the subsidiary books and getting rid of it, and we're recording minority interest that doesn't go on anybody's books, and we're revaluing the assets, in this case only one building, but that doesn't go on anybody's books. Do you have the idea? Just for consolidation. Everybody needs that idea. It's pretty tough to figure out. Okay? So let's try it. Let's do our journal entry. Bet we can do this now. It's right here. Everything's right there. I want to get rid of the equity of the subsidiary. What do you want to do to get rid of it? This is the elimination entry now. Elimination journal entry. Only on a worksheet, right? To do your consolidation, to get your consolidated financial statements. Okay, what do you want to debit? Common stock's got to go away. How much was it? 200 grand? It's gone. What else do you want to get rid of? Thanks for sticking around, you guys. And then you got another class coming. Then what? Additional paid in capital, common stock. How much was that? And what else do we have in the 700,000 equity? Retained earnings. So we've got those 3. Well, how much was that? 400,000. So there's the 700,000. Does everybody see what I just did? I'm debiting all of those because the equity of the subsidiary was 200 common stock plus 100 additional paid-in capital common stock plus 400 retained earnings, and I am getting rid of it. Only in consolidation. I'm not doing it out on their books. That company still exists, okay, guys? They still are functioning, doing their own financial statement. This is a consolidated statement. Okay, what else do I need to get rid of? On the parents' books, what do I have relative to this company? Investment in subsidiary, Lucy, right? If you put the companies together, what's that going to be? An investment in yourself? And so you got to get rid of it. So, investment in subsidiary. And you might have a number of them, so you can probably put their name on it. Lucy, how much is that? What's in the books for them? What did we do it? What did we put in there? $1,080,000. Okay. This journal entry is a long ways from balancing, but it's going to be fine, isn't it? What do we want to revalue? Land. Let's put 20 in for land. Whoops. Building, wasn't it? Not land. It was building. Can't even remember my own example. Okay. So you debit building. My point is, this could have been land. The other example we did could be equipment, could be inventory, could be all kinds of different accounts. Got the idea? And it might be 20 accounts get revalued. Okay? Liabilities could even get revalued. Got the idea? Okay. So how much? You want to debit goodwill? I like it. How much is goodwill?
430.
430,000. Excellent. Wow. So we've eliminated the investment off of the parents' books, right? We've eliminated the equity off of the subsidiaries' books, every equity account. We revalued an asset, only one in this case, but it could be more. And we recorded goodwill for the difference. Does my journal entry balance? No. What am I missing? I didn't do my minority interest yet. I don't own 10% of the company. So 10% of that 700,000 of equity was how much? 70,000. Everybody got it? So minority interest. And this is sort of a quasi-equity account. I'm going to show it between equity and liabilities on a line all by itself. Minority interest in other companies. 70,000. Now does my journal entry balance. That's it. The whole world, huh? That's a lot to get down, John. Okay, that's a nice example, though, huh? You pound through this, you can think about it. Look back at the other example. They're on the quiz, guys, right? They're on the test that you have to practice with. So do it. Okay. And I'll remember to record this one and yesterday's. Nobody could listen to yesterday's right now. It's impossible to follow. Slide. Okay.